Namaste and welcome to Concepts with Karan. I'm delighted to have with me today Amit Tripathi, the fixed income CIO at Nippon Mutual Fund, one of the brightest fixed income managers in India when it comes to its entire range of fixed income funds. Amit, such a pleasure to have you in this conversation
today.
Thank
you, Karan, and thanks a lot for all the appreciation. I guess some of it is coming from knowing each other for many years.
For many years.
But I'll take it.
Yeah, most well deserved. One of the unique things about Amit is that you've been on both sides of the table.
Yes. As an investor also.
As an investor and now as a fund manager. Maybe that's where we should start, that on being on both sides of the table. How has been the transition and the journey, and is there anything that came out unique in that whole process when it comes to managing money for Nippon?
Yeah, so I think that is a question that nobody has asked me in my last 20 years, and I would definitely want to answer that question. I think my learning phase as an investor was very critical when I was transitioning into Nippon. The reason it was critical is because I already knew or I thought I already knew some of the aspects which make asset managers, specifically mutual funds as asset managers, as a very differentiated proposition vis-a-vis most of the other traditional avenues of savings and investments that we look at. And that differentiation came at various levels. That differentiation came in terms of offering market-linked returns. That differentiation came in terms of fund management expertise and the knowledge and the domain expertise that comes along. That differentiation came in terms of risk management, which may not have been a spoken word at that point in time, but was pretty much there in terms of how people went about managing their portfolios. That differentiation came in terms of how partners, including internal partners such as employees of that firm, as well as external partners who were working with that firm, used to differentiate between various products and various AMCs in terms of their processes. So I think when I came into this industry, I had a very decent feel, I believe, in terms of what this industry offered to the investor. And in the last 20 years, whatever little we have only tried to ensure that that offering gets better with time. And that offering is essentially true to label. So that in a nutshell is the transition.
Yeah, and it's a big, 2 decades is a very big learning process. So let's start with this entire 2 decades of experience. And now, when you look at it from your perspective as managing all this money, a few words that you used were process and risk. And can you start by explaining in depth the 2 words, because that inherently results in performance.
Correct.
Performance is a byproduct of the way we kind of look at these 2 words.
Correct.
If you could just start with a little bit of process and risk that you do at fixed income for Nippon.
Yeah, so you're absolutely right, Karan. So we cannot determine output, we can only determine input, right? So input, essentially I would divide into 2 parts here. One is the input that goes into managing the product, and second is the product itself, which is an input. Because both these as a combination give you whatever delivery that you give to the end investor, right? Now, the process and risk management part, I'll just start with an example to give you the picture in how we think about it and how this works. So as an investor, if you were to, for example, want to invest in a moderate risk product and you want to do it as part of your normal debt allocation, possibly the oldest product in the mutual fund system is a product called the short-term bond fund, right? It's a moderate risk, moderate return expectation product. It's typically high grade for most purposes, predominantly AAA, AA kind of portfolio, and it maintains a duration range of 1 to 3 years, broadly speaking, right? That's the outside view of what this product is.
Right.
And that is where the outside view starts and ends. The inside view is very different. The inside view is that first you design the short-term fund to align it with that outside expectation. Okay. while you are designing this, you actually have to define risk much more clearly, because like I said, returns is a potential of the market and that product itself, but what is in your hands is defining the risk. Right? Now, to give an example, if the investor looks at two short-term funds and he says that one has a duration of 2 years, the other has a duration of 2 years, on the face of it, he cannot differentiate between the two, right? Because both products look very similar from a top-down view. But risk management at Nippon is all about bottom-up. Okay, so one of the in-house ways in which we have tried to achieve this bottom-up view is something called the fund casing. Okay. Unlike a top-down view, the fund casing actually starts at defining risk at an instrument level. About 5 years back, when we used to define risk at instrument level, we were restricting ourselves to defining it in terms of credit risk and interest rate risk. As part of the improvement of the process that we have seen in the last few years, we have added 2 more risk criteria to that. We have added a liquidity risk definition to every asset. And we have added a concentration risk definition to every asset, right? Because when I look at risk return in the traditional sense of interest rate and credit, what I'm missing out is that what is the impact of an asset on the portfolio per se, which comes via concentration or lack of concentration. And 2, because I am managing an open-ended fund, it is very easy for me to construct a portfolio, but to manage the portfolio dynamically with inflows and outflows happening, I need to look at the inherent liquidity also, right? So start by defining the instrument at these 4 levels: credit, interest rate risk, liquidity risk, and concentration risk. Put boundaries at each level of risk, at each instrument at an individual level. Then aggregate it, ensuring that the nature of the product is intact. Okay. As a corollary, if I am managing something like a short-term bond fund, I am just using short-term bond fund as an example, I know that the mandate here is moderate risk. So when I am achieving the 2-year duration, I am not only looking at 2 year in isolation, I am actually looking at each instrument having some limit of duration. So I can achieve a 2-year duration by running some part of the portfolio in 20-year instruments also. That is risk management. That is what comes as fund casing. That at each instrument level, you are also saying, for example, in a short-term bond fund kind of a format, that I put a 5-year duration cap on each instrument. Similar thing with credit risk. Similar thing with liquidity risk.
And similar with
concentration. That on the concentration side, there are clear defined regulatory risks, regulatory limits, for example, based on the rating of the asset. But do you want to stay at that level because these are dynamic portfolios where AUMs can increase or decrease at any point in time, or do you want to live much lower than that and diversify the portfolio more? Okay, and last, on the liquidity risk side, do you go by this general definition of liquidity, or do you actually look at the real life liquidity of each asset and each asset class and define it in terms of numbers in your system and employ that diligently every time you are making a asset selection in terms of purchase or sale? So when you do this in a very bottom-up fashion, what you ensure is that the product actually ends up becoming what it is supposed to become, right? Then at the end of the day, what you deliver is market returns, but what you essentially ensure is that the investor does not get negative surprises, because you are not achieving that construct or delivering that return based on some risk that goes beyond a particular threshold. You are marrying the risk of the product to the profile of the product, being true to label. That is how you define risk management, or the Nippon way of looking at risk management is how you would look at it.
I think what you've done and what I'm understanding from this example is also the fact that you've taken a very simple product's idea and gone into the depth of how supposedly a simple product should be a very simple construct. But actually that's not necessarily true, because that's where all the money is coming in as well.
Correct.
So the experiences have to be really, really good.
Correct.
And so let's just delve more into this. You use the word fund casing a lot in this conversation. Can you throw some light on that? Because I've heard fund casing a lot in equities.
Okay.
And of course fixed income. Now it's starting to take much more predominance because of some of the issues that probably we faced in the past as an industry. Maybe some light on fund casing and how that's helping you all.
So, part of what was I explaining to you is essentially the heart of fund casing that that's why I use the word so many times. I think the way I would think about fund casing is, historically whenever we talk about funds or about products, we always talk about positioning. Okay. Positioning is a very top-down kind of an approach. Casing, fund casing, at least the way we define it, is a very bottom-up kind of an approach.
Okay.
So the way I would think about this is that in the Nippon scheme of things, fund casing is about controlling risk at every level rather than controlling risk only at an aggregate level. And this gives you much better control when you do it bottom-up vis-a-vis when you try to do it top-down, because then you are forcing something on a product which is not meant to give that kind of a risk profile. It might be a very differentiated risk profile, but you are just simply on a top-down basis trying to manage that risk profile. Rather than that, organically do it bottom-up fashion so that the product actually stands for what it is supposed to stand for and is true to label, so to say. So that is the most critical aspect of fund casing. Now the other thing which I think we should also highlight here in fund casing is that the moment you start saying that I am putting boundaries around every risk characteristic of every single instrument, the next question that comes is that the tighter you define those risk boundaries, the more difficult it becomes for you to generate alpha.
I was just going to come to that, yes.
Because I think the conversation that we all know is that, the biggest difference between an active mandate versus a passive mandate is in one, you are trying to generate market returns by mimicking a market index, whereas in active you are actually taking a view in terms of varying the proportions vis-a-vis the market index and trying to generate returns, right? So the more you define this tightly, the lesser the space or flexibility, right? But I would think that at least in the Nippon scheme of things, it is by design. Okay? And the reason is very simple. The reason is that when we look at creating reasonable returns for the investors, we don't want to do that by taking excessive risks in the context of a fund. We want to take the right risks but ahead of the markets. Okay? And the only way that is possible is if the input that goes into this process is of superior quality. So one is I can define risk by defining fund casing very well, but once I have defined risk, I also my basic mandate is to give reasonable returns for the level of risk that the investor takes. And that can only happen with this type of fund casing mandate by having the rigor on the input side. And what is that rigor on the input side? Very simply, in plain and simple words, research, right? Now, whether it is, and research is nothing but a compilation of the market understanding, which comes in various buckets, whether you call it macro bucket, whether you call it the credit bucket or micro bucket, and whether you call it the market dynamics bucket, which is the so-called expertise that people develop over a period of time by staying in the markets and understanding market dynamics, right? Which works a great deal when you're looking to manage things like liquidity risk, concentration risk, etc. Right? So all these three inputs in terms of research have to be of very high quality for you to be able to generate commensurate returns with tight risk management framework. So both in that sense go hand in hand. I need this because I need to manage risk effectively, okay, and not just figuratively, so to say. And I need an input so that I deliver commensurate returns or reasonably good returns, even while managing risk in a very tight fashion.
So let's focus on this other input that you've just spoken about, which is research, which gets us to also the people factor.
Correct.
So let's just spend some time on understanding both research and people, and how have you built that at Nippon. And why I asked that question is also because research on the fixed income side does require a lot of work. How is the team set up, etc.? If you could share that.
So good that you mentioned that it requires a lot of work, because that is also a part which is generally not spoken about when we speak about fixed income, right? I'll give you again a very simple example where research makes that differentiation, right? for example, if you were to look at the rating universe today, general connotation is that a AAA is the best credit quality, AA is the second best, single is the third best, so on and so forth, right? What you would not generally have a conversation with is that within AAA, there could be assets that trade at just 20 basis points above a government security, and there could be assets that trade at 150 basis points over a government security within that AAA.
Within the
space,
AAA.
right? And most of the negative surprises that we see on the credit side, especially in the Indian context, is not because of people having invested into single A's, but it happens because you are looking at an optical comfort around a rating, but you are not understanding that the same rating category could have varying degrees of risk.
Right.
Okay. So, to explain it very simply, that is exactly what research does.
Sure.
Research helps you understand the reason why something trades at 20 basis points versus 150 basis points. More importantly, research helps you make that decision on whether that 150 basis point that you are getting in, is it an opportunity or a risk? Okay, so in terms of input on whether it's an opportunity or risk, that is a very, very critical function of research, right? And this is just one part of research, which is credit research. Similar things or similar importance is on the macro research side, because ultimately fixed income is as much about rates as it is about balance sheets. And the third part, which is the market dynamics part, is equally important, because that is what ultimately helps you use these two inputs in that fund casing framework to generate commensurate returns. So that is the third part of input that goes in, which I club it with research, although it's a very thin line on what comes as research and what comes as fund management expertise. So I think these are the three inputs that one looks at, and at least at Nippon today, 50% of the team strength on the fixed income side is actually dedicated only to research. And we don't have mixed mandates saying that a fund manager can do research or a research guy can become a fund manager.
Completely segregated.
It is completely segregated. Fund managers are not the research guys, and research guys do not even transition into fund management.
So they're very separate.
Very, very separate paths that we have taken on the fixed
team is divided between research and fund management, which is quite unique. And did you all reach this space after time, or was it something that came naturally? Like, was this after a lot of time spent into managing money?
So there is always a trigger for everything. I agree with you, and I think the trigger for us, especially to appreciate the fact that if I have to offer fixed income products across the spectrum of interest rates and credit risk, and each product, like we have already discussed, is very, very unique. So you can't offer the same package across products, okay, because the mandates are very different, the regulatory framework is very different, so on and so forth. Then there is no substitute for having adequate internal strength and high quality strength in terms of research. For us, possibly, while we had that as an input almost since the time I joined here in 2003, the focus, I would say, increased significantly more after the 2008 environment. And not only the dynamism in the markets went a complete shift after that, but the differentiation that research could bring about was also clearly felt in the environment going forward. So I would say that the trigger for the AMC per se, and I'm only talking fixed income
of
here,
course,
and not that we didn't have a presence. I'm only saying that this clear focus that a significant part of your effort, input effort, outside of fund management expertise has to come from research, is something that possibly triggered somewhere around 2007.
So let's just spend some time on understanding the team and the people behind this entire fixed income space. And so there are two questions I have. One, of course, you've very nicely explained the rigor, but I wanted to understand success metrics for the team. and how do you view that as the CIO for fixed income? Because finally it's linked to performance for the investors. So if you could throw some light on that.
So I think first is the basic success metrics that every person in the fund management team has, and which is I would say almost 100% defined in terms of numbers. Okay. Every aspect of performance that we look at, whether it is in terms of the fund management team, the dealing team or the research team, is quantified, is spelled out very clearly as part of their KPIs, is regularly discussed, feedback taken, feedback given, incorporated, and everyone knows when they start and throughout their journey that this is what is expected from them in numbers. So I think we have tried over the years again to make this as objective as possible, so that there is clarity on both sides. One, at an individual level, everyone is very clear what is expected from him, and two, that there is no disappointment or no sudden I don't know what is the opposite, anyways, elation that you are being judged on performance which is very different from your expectations, because the expectations are pretty much concretized in terms of the KPI itself, which is a very, very objectively defined KPI, right? I'll give you an example on the research side, because see, unlike fund management, which is you can really look at performance and figure out how do you judge input. So for example, when you're looking at credit research, so just to give an example, the criteria obviously for somebody who is managing part of the universe of approved issuers that we have, or looking at new issuers that get added or issuers that get removed from the universe, etc., etc. Apart from just looking at a plain vanilla thing like an upgrade downgrade, you actually look at the time to upgrade downgrade after the recommendation. Okay, and you define that in numbers. So what that does is that it makes you much more proactive. You are the only way to actually create differentiation in this space is actually to know the right thing, but to know the right thing ahead of when the actual rating action happens, right? And hence that is captured in the KPI in terms of numbers.
Got it.
So I think even on the research side and clearly on the fund management side, everything is as objectively defined. Beyond this, obviously, as an organization and as our DNA, we have always focused on ownership as a quotient for determining any person's success over a period of time. And that sense of ownership partly is captured in KPI, partly goes above KPI as well, right? Because the sense of ownership is not about just achieving what is written on this piece of paper. The sense of ownership is also about trying to improve this, trying to improve the process, trying to come up with ideas, trying to come up with suggestions. Anything that improves fixed income in terms of process, in terms of input, in terms of output. In fact, even going outside fixed income, anything that the person looks at in terms of his own ownership, in terms of how to improve process within the organization. All these obviously are not defined in the KPI per se, but all these I would say are softer aspects that we look at, and accordingly gets reflected in the person's journey through the organization.
So Amit, I just wanted to even speak about something that I came across in the Nippon papers that I was studying. The acronym INCREASE.
Yes.
I know about INCREASE when it comes to increase in performance or increase in output or research, but what does INCREASE mean when it comes to process? If you could throw some light on that.
Yeah. So we think increase is a very, very positive term, because all the three things that you mentioned when you mentioned increase were all positive, right?
Yes.
Either in terms of performance or process or research.
Absolutely.
Right? So as a firm, we believe what we deliver in terms of the various aspects that we just thought about can be acronymed as increase. Essentially, if I were to just break this up, first obviously would be the in-depth research input that goes into the product. The second is about risk management, which is more concretized and defined in terms of the fund casing. The third is about the the portfolio management aspect and the review of that portfolio management aspect, which we did not touch upon in our conversation. So one thing we want to highlight here is that we have again developed into a unique internal system called PDCA. Because once you have the inputs, once you have the fund casing, then you actually put that into the product and try to deliver that product. Now, in that delivery process, are you actually achieving what you set out to achieve, or there could be improvements along the way? Because this is a continuous process improvement process, right? And this feedback loop is what PDCA or what the review is all about, which is very, very formalized in terms of how the return and risk of that product is getting managed on a concurrent basis and getting that feedback and improving on the process itself. So that's this very strong in-house formalized review mechanism. And fourth, ultimately, is about the E. The last E stands for employee. It's all about ownership at the end of the day. The best of processes, the best of inputs, the best of expertise can go and make that winning combination only with an employee. And that employee is one with a very, very high degree of ownership in terms of what he takes to deliver or to execute. So obviously we know that that's the heart of the organization.
Sure.
To say. And
that's the acronym for increase. Makes a lot of sense. Super. I want to end this conversation with one aspect which has now taken the industry by a little bit of surprise, which is the change in the taxation for fixed income. While that is across the board and it's just not a Nippon effect, how do you, as like the CIO for fixed income, then look at the new challenge of taking fixed income products out when the taxation advantages have been taken away? Because that is an opportunity as well, because the more the rigor and the differentials possible, that you could stand out more. How do you view that, and any comments on that?
Yeah, so the first thing, which is a very generic understanding, is that now you are not competing with 42 competitors.
Yes.
But you are competing with more than 100 competitors here, right?
Yes,
because the competition is not only in terms of your peers on the mutual fund side, the competition is also with traditional savings products. The competition is also with people who are running investment business outside of the mutual fund framework, so on and so forth. So one clear understanding that we have from day one is that the canvas becomes much more larger in which you evaluate yourself.
Right.
That's number one. And number two, accordingly, it becomes very, very important to actually focus on two things. One, the product itself. The product needs to be defined that much more sharply going forward in terms of what it does, what it does not do, and what is the requirement that that product fills in. Okay, just to give you a small example, I would say at the margin, there has been a tendency that has developed in the industry when the indexation benefit was available, that every product that was offered outside the liquid space was offered with a mindset of 3 years investment horizon, right? To give you a small sense that, again, the same fund that we talked about, short-term bond fund, ultimately it's an intermediate duration moderate risk product, right? In specific market conditions, that product can actually be very suitable for allocation over a 12-month period also. In specific market conditions, it may not be suitable for that shorter period, and investors need to look at it from a slightly longer period perspective, right? The indexation benefit goes away. It makes it more important for us to define that for our investors, right? So I think the product has to be defined much more concretely now. So that's one aspect. The second aspect is, I think it is very, very important for us at Nippon and also for the industry, which we realize and which we are trying to do, is to differentiate in terms of process and risk management. I don't think in many cases the products that we talk about are very, very differentiated products. In fact, they are very, very normal products from a definition perspective, right? What differentiates them is the process, the risk management, and the expertise that you bring to the board, right? The input factors that we talked about. So I think these three things need to be clearly highlighted both in terms of the actions in how we go about managing the product as well as in terms of communication, because this is something that every investor who gets into any kind of investment avenue should understand about that investment avenue before he gets into it.
Correct.
Not the potential return, but what goes behind that potential return getting generated and how is that generated as a process.
Yeah.
And what are the risk mitigants that are built in. Yeah. So I think that is the second most critical aspect. And the third most critical aspect here is the track record. Ultimately, whether it is, financial products are always about comfort, comfort around the process, comfort around the brand, comfort around the risk management, so on and so forth. It is everyone's hard-earned money that they are actually giving to somebody else to manage, right? So to that extent, the fiduciary responsibility that we have has been always very, very high, right? And it is that fiduciary responsibility that the industry has actually carried for so long, so successfully, that should become the differentiated factor going forward. So yes, I know that indexation going out is big news, but at the end of the day, ceteris paribus, all other things being equal, these are some of the things that we bring to the table.
Absolutely.
That not everyone would be able to bring to the table.
Absolutely.
So I think that is what is going to hold us in good stead over long periods of time. It really does not matter what happens over a 2 month, 3 month, 4 month, hardly 4 months since the time the indexation went away. So it's a long story to be written, and I think it will be a good story that will be written.
I totally agree. In fact, on that point, Amit, both at Nippon and in the industry now, there are track records of fixed income funds for over 2 decades.
Correct.
And they're actually in the wealth creation category.
Correct.
That's the kind of decadal performance that fixed income has had, both at, from gilt funds down to some of the short-term funds that you mentioned about. So the track records are there for everyone to see. But what was very interesting for me to understand was the in-depth rigor that each and every instrument goes through at Nippon, and the fact that you have a research team which is dedicated to only research and a fund management team which is separate, and the entire input that goes into creating the performance. So thanks a lot for sharing all of that. It's been a refresher course for me.
No, thanks a lot, Karan, for giving up this platform to share our views, and hopefully this will be of some help to people.
Oh, a lot of help. Thanks a lot, Amit. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.